Materiality is defined in the auditing standards as the amount of misstatement in the financial statements that would cause a reasonable person to change their decision. Materiality is assessed by the auditor in both quantitative terms, for example, $5,000 or 10% of assets, or qualitative terms, such as a high amount or low amount. There is no set number or percentage listed in the auditing standards. Materiality is a matter of the auditor's professional judgment. During planning, the auditor determines the largest overall dollar amount of misstatement that they can accept without changing their minds. Once the overall dollar amount is selected, the auditor then divides up or apportions the overall amount among the financial statements. This is called assigning materiality at the financial statement level. The auditor will also divide each financial statement amount up among the accounts listed on each financial statement. When the auditor looks at the overall materiality, they look at the largest amount. When the auditor thinks about the financial statement level of materiality, they select the smallest dollar amount they can possibly live with and still make the same decision. For now, remember that the amount of materiality established during the early planning of the audit is called the preliminary level of materiality, and that material misstatements could arise from errors, fraud, or illegal acts. Audit risk is also assessed during audit planning. What is audit risk? Audit risk is the risk that the auditor could attach an unmodified audit report, in other words, the standard clean audit opinion, to financial statements that are materially misstated. This is not the thing to do. You do not want to claim that the financial statements are fairly stated in accordance with GAAP when they are not. Audit risk consists of three components: inherent risk, control risk, and detection risk. The auditor first looks at the level of inherent and control risk. This is because these risk components are factors of the client's environment, and they exist independently of the financial statements. Inherent risk is the risk that is due to the very nature of the account or situation. Inherent risk says, assuming that there are no related internal controls, what is the risk that the financial statements could be materially misstated? This means set the internal controls aside and look at the very nature of the situation. For example, compare cash with prepaid insurance. Just by the very nature of the account, cash is more risky than prepaid insurance due to its liquidity and high demand. Prepaid insurance is easy to recompute and verify. A more complex transaction has more inherent risk than a simple computation. A client with an inventory of computer microchips is more risky than a client with an inventory of refrigerators. The microchip business has high technological change. The chips are in demand, small, and of high value. They can easily be stolen. When was the last time you saw a refrigerator being stolen? That's just it. You would notice this. When there is high inherent risk, an auditor must audit more. When an auditor must audit more, it means they must conduct more substantive type tests by lowering the materiality amount. Control risk refers to the client's internal controls. If the auditor assesses, finds, control risk high, it means they think the client's controls are ineffective, or maybe worse yet, non-existent. When a client is not using internal controls, the auditor will assess the control risk as high. If the controls are in place, being used, have been designed, and are operating effectively, the auditor can assess control risk low, accept more detection risk, and decrease the amount of substantive testing. I liken it to a seesaw, where when a person sits on one end, the other end goes up. If control risk is high, Then detection risk, the risk that the auditor's procedures will not prevent or detect a material misstatement on a timely basis, must be kept lower. The only way an auditor can keep detection risk low is by performing more substantive tests closer to the balance sheet date. When control risk and/or inherent risk are high, keep detection risk low by performing more substantive tests. It's an inverse relationship like a seesaw. What situation is the best for the auditor? The auditor would prefer to find inherent risk and control risk low. Then down goes that risk end of the seesaw and up goes the detection risk. This means the auditor can now accept more detection risk. They do not have to perform as many substantive tests. This relationship will be further discussed in the Module 2 CD, Internal Control. There is an inverse relationship between audit risk and materiality. The relationship is described as follows. While there may be a small chance, risk, that an account could be misstated by a large amount, there could be a large chance, risk, that an account could be misstated by a small amount. Don't fret too much about this relationship. Just remember the inverse relationship between audit risk and materiality, and that both audit risk and materiality may be assessed in either quantitative terms or qualitative terms. When it comes to risk, the auditor wants to keep audit risk low, about 1 to 5%. This means that the auditor is willing, at the most, to accept the chance that 5% of the time the auditor could attach an incorrect audit report to the financial statements. If you accept a 5% audit risk, you want to be 95% confident of attaching the correct audit report. If you select a 3% audit risk, you want to be 97% confident of attaching the correct audit report. The only way an auditor can control the inherent or control risk is by doing more audit procedures. Audit procedures mean more substantive tests. Keep detection risk low by performing more substantive tests. A fairly new planning requirement is that of assessing the risk of fraud. Fraud is defined as an intentional misstatement. The auditing profession separates fraud into two categories. 1, misappropriation of assets, and 2, fraudulent financial reporting. Examples of misappropriation include stealing, embezzling, defalcation, and causing a company to pay for goods that they have never received. Usually, a single person misappropriates to personally benefit themselves. Fraudulent reporting involves making false entries in the financial statements to overstate or understate accounts. It includes the falsification of documents and records. While a single person often misappropriates, senior management usually commits fraudulent financial reporting. Why? They want to maintain the appearance that the entity is still performing well. Senior management does not want to risk the chance that their stock prices will fall or their bonus will be lower if the financial statements don't show positive results. So, they cook the books by falsifying records and documents. GAAS requires an auditor to specifically assess the risk that fraud could cause the financial statements to be materially misstated. The auditor assesses this risk through the use of a checklist, which lists various fraud risk factors. The auditor completes the checklist, identifying whether the fraud risk factor is present or not present. For example, if the risk factor is present that a significant portion of management's compensation is based on the results of the financial statements, such as commissions or bonuses, the auditor should spend time documenting how the scope of the audit will be adjusted to compensate for the high risk of fraud. Be careful, though. Just because a fraud risk factor is present does not mean that the auditor must audit more. If controls are in place to prevent or detect the fraud, then the chance of fraud occurring is rare, and the auditor need not expand the substantive testing. Candidates, you should obtain a CPA review manual, such as the Wiley CPA Examination Review, and study the fraud risk factors. Note the auditor is not assessing the fraud risk factor as high or low. The auditor is merely looking to see if the chance of fraud could occur because the fraud risk factor is present. When the risk is present, the auditor should adjust the audit scope by performing more substantive tests.